Lots going on. Why are Americans broke in 2022?
It's Brian Preston, the money guy.
Yeah, Brian, I'm excited about this because there's some unique things going on right now. This is a unique time. And I think maybe not more than ever, but more than recently, things are feeling kind of interesting. There's a lot of sort of macroeconomic factors happening that perhaps are making folks feel, or maybe not even feel, actually making folks not have a very strong army of dollar bills right now.
Well, this is one of those topics. I mean, we've done this type of content in the past, and previously, I spent a lot of time, and we'll talk about this today too, some discipline type issues,
Sure.
But there really are macro things that are also impacting a lot of people's financial decisions. And we wanted to kind of jump into what's going on in the economy, but also talk about what you can do, because there's a lot of this stuff you don't control, but there are things you can actually do to navigate these unique times well.
And so let's talk about some sobering stats, some stuff that kind of, I think, for financial mutants, this should kind of hit you in the face. The first one is 64% of Americans, according to CNBC and Bankrate, 64% of Americans live paycheck to paycheck.
Yeah, by the way, this is a 2022 piece. I mean, when I saw this, I was like, where is Daniel pulling this updated data from? But this is from March 8th of 2022. There's another stat, because this one, by the way, this is an improvement, and I think this has a little bit of an overhang from the pandemic and some of the stimulus money and other things that were coming out there, is that 56% of people don't have the savings to pay for a $1,000 unexpected expense. You guys know, if you've been following the Money Guy, it normally hovers right around 60%. So this is a slight improvement, but still it's kind of sad that we're celebrating 56% of people can't even come up with $1,000.
And you know, if you follow the financial order of operations, one of the first things we say is you got to have your deductibles covered in cash, in an emergency fund. What this shows me is, like, just to cover your deductibles, you're probably getting close to that $1,000 number in an emergency fund. Most folks aren't doing that. And you may be thinking to yourself, well, this is a lower income problem. This, some folks just kind of grow out of this. This is more of a function of income and less a function of behavior. That's actually not true. According to Bankrate, and again, this was the January study, 17% of Americans making over $100,000 can't cover an unexpected $400 expense. And I would say if you're someone in that strata of income, you should be able to come up with $400 for an unknown expense that pops up.
And I love, since we have a regular schedule creating content, but we get to give clarification on a slide we did not too long ago where I was talking about people who were in the top 10% carrying credit card balances, and the average balance was around $12,890. A lot of people in the comments were saying, yeah, but that's probably the amount that they're paying off every
Includes
month.
all
That is
people.
not, if you notice, we were very, very deliberate with the fact that we said carry an average credit card balance. These are people not paying it off. So it is sad to see that the top 10% of income creators a lot of them are carrying credit card balances.
So I think what that shows is that this is not an economic problem in terms of socioeconomic status. This is pervasive throughout all socioeconomic strata, right? Americans, by and large, are not making fantastic decisions with the money. They're not in fantastic place financially. And so the question you're probably asking is why, right? Why is this the case right now, or is right now different? And there are some really, really unique things going on. I think probably the elephant in the room that we're all aware of is right now housing is unique. What we're seeing going on with home prices in this country is very, very unique relative to what we've seen in the recent past.
Yeah, I mean, we talk about, you hear about the latte effect, and the latte effect, those small decisions don't have as much impact as these big ones, like your home prices, your automobiles. And we all know on the macro sense of the economy right now, there is some unique things going on. I mean, look at what has happened on home prices since 2000. Now, look, we've got this, you can see, yes, there's been increases. We all count on that. Inflation, we know that prices are going to go up 3 or 4% a year. But look at what happened when the pandemic hit in 2020. This thing has been like a hockey stick. I mean, there is no other way to describe this. We show a 33% increase in home prices really since 2020. That's unbelievable.
But it's not just the price of homes that's increasing. If you look at 30-year fixed mortgage rates in Q2 of 2020, they were at about 3.23% on average. Fast forward to today, and interest rates on 30-year mortgages are close to 5.5%. So we've seen a drastic rise in housing prices, and we've also seen a big increase in what interest rates are for people that are trying to go out there and get mortgages, buy their first homes, and actually borrow money to get into a home.
Yeah, I mean, what I think is interesting is you heard me, I shared since 2020, 33% increase, but I think that mutes the real impact of what the cash flow.
That's right.
And how does this flow through to the monthly payments that people are paying? When we did that, because we use those interest rates you talked about, 3.2% just a few years ago. Now we're over 5%. It actually leads to the cash flow impact, meaning housing can be up 74%.
Yeah.
That's unbelievable.
And we're not talking about just in high cost of living areas or where this is the median, right? So this is across the country. The cost of home ownership after adjusting for interest rates is up like 74%. So if you are that young person just starting out, or maybe you've been in your career for a while and you're ready to make that jump into home ownership, it literally feels like it is a car that is pulling away from you, this thing that you can't get caught up to. So it's hard, it's difficult right now, but housing isn't the only thing. We're also seeing the cost of other goods go up. When we talk about the general inflation, you can see, if you look at this chart from 2015 until now, inflation kind of hovered from 2015 to 2020 somewhere between 1% to 3%, right, on average. But coming out of the pandemic, it spiked where now we're seeing consumer inflation up above 8%. Not just the price of housing, but the price of things that we buy every day to live the life we want to live are getting more and more and more expensive.
And then, you guys know, we started creating this content in 2006 because I love the power of education. Is that it doesn't matter where you come from. If you can learn, investing yourself, you can better yourself, and you can also, somebody can hopefully hold the ladder of opportunity for you to get better. But it does break my heart that the cost of education has become more of a encumbrance than it is a benefit when you think about student loan debt and how it's increased. And we even had a slide that blew my mind, Bo, in the fact that we count on that there's young people that are running up student loan debt. But I was really surprised that the largest group of student loan debt holders is actually Gen X.
Yep.
That's my generation. And you're like, well, surely that's not their student loan debt, because when I went to college, relatively speaking, it was a lot cheaper. I mean, significantly, probably a tenth of the cost that things are right now. So all that this leads me to believe is that a lot of the student loan debt that's held by Gen X, by the boomers, and even the silent generation is parents and even grandparents taking down student loan debt so that their kids and grandkids can go to college, and it's just gotten too expensive.
And this has to be a problem. There has to be something that happens to fix this. If you look at the average student loan debt for graduates in 2020, it was about $28,400. But now we see millennials student loan debt, and this is people going back to college, accumulating additional debt, is at 35. Gen X, you said, is the highest, is at 40. Boomers are at 35,000, and then the silent generation, those 75 and above, still have student loan debt of 75. If you listen to our show for any amount of time, you know that we say by the time you get into your 50s, by the time that you get to that part of your financial life cycle, student loan debt should be going away. It should not be happening. Even if you're helping the next generation of the education, there are some ways you ought to think about that as it relates to your personal financial situation. So one of the questions people ask us all the time, Brian, is, okay, I'm coming out and I've got this student loan debt. Yeah, maybe I shouldn't have done it, or maybe I should have done it differently, but it's a fact. I have it. What's the best way for me to approach paying it off? Do I just stop everything and knock out these student loans, or do I take some different approach to try to get rid of it?
Yeah, we're fortunately, we've put together a plan. As you said, it's prioritizing based upon risk premiums, inflation, where we are with Treasury securities. And it's exactly what you shared, Bo, is that anybody who's, because you have to define what is low interest versus high interest, because we talk about in the financial order of operations all the time that, step 3 is paying off high interest debt, but it's not until you get to step 9 that you pay off low interest debt. So we need to define that. And we did based upon all those variables I shared previously. For somebody in their 20s, that number might be as high as 6%. For somebody in their 30s, 5%. And for somebody 40 to 50, it's 4%. And after you're over 50 years of age, you really should be trying to get out of all debt. We tried to really make that as streamlined as possible. And if you're trying to figure out, hey, what can I do? Because I want to get into a lot of this stuff is things you can't control.
That's right.
Let's get into things you can actually control. And we've actually got a whole path forward to help you navigate this.
Yeah, unfortunately, you can't control what happens in the cost of housing. You can't control what happens in the student debt market. You can't control inflation. I mean, maybe you can control what job you take and what part of the country that you live in. But by and large, and because we've been doing these shows for long enough, we know that while right now is difficult for most Americans because of these other events, it is not just right now that folks are making bad decisions and are ending up in less than ideal financial situations. So we want to walk you through what you can do, ways that you can protect yourself, ways that you will not fall into those statistics. And the first one is plain and simple. If you've been listening to us for any length of time, you know this is something we believe makes sense, is we feel like a lot of folks that find themselves in that situation where they can't come up with $1,000 or can't come up with $400, they simply don't have a plan in place.
Yeah, let's jump into a few of these things because I think it's important to understand. I mean, the biggest part is like debt. I mean, a lot of people, I think that is the trap that a lot of people are falling into. As I've shared, housing is running away from people. Cars are actually appreciating in some weird way. So how do you have to have a plan to tackle these things. And one of the things I always tell people is we're looking at this, because I really do. If you want to know how nerdy Bo and I are, I sit around and actually think about what are things we can tell our audience to navigate these unique times. And I had a lot of conversations this weekend about housing and specifically. Sure. And here's the good news. With interest rates going up, I do feel like some of the craziness is being squeezed out of the system, meaning that due diligence is being added back to where you can now do inspections. You might be able to actually put contingencies, because if you don't have 20 offers on a piece of property, you're actually going to have the ability to navigate this. So I would tell somebody, have a plan how you can handle that. Doesn't fix the debt part of it because you still with the rising prices, but you at least now can get some normalcy and then apply all the great things like, am I going to live in this house for the next 7 years? Am I moving? Cars, slow down. I know you're probably going, I hate that people aren't going to be able to buy cars like we normally have. There is an aging of the fleet of cars that we're all driving, but it is allowing you, I think this situation, I would sit back, wait, and I think that if you could plan for the future, you'll have an opportunity to correct that as well.
Yeah, I think one of the things that's interesting is most people hear plan like, oh man, that means it's got to be something complicated. That means it's got to be something hard. And I think it was Benjamin Franklin that said this. You made fun of me because I normally say that he's the guy, but I think he actually said this. When he has this quote, it says, failing to plan is planning to fail. And there's some truth in that, but you don't need to get caught up in the complexity of it. For you, creating a plan might be just putting together a budget, or it might just need to be something like, hey, my plan is I'm going to save 25% of my gross income until I reach the point that then I need to think about other things like tax analysis, like insurance planning, like college planning, like fill in the blank. But those folks who don't have a plan, and Brian, I'm going to give you credit for this nomenclature because you're the one who says this. If you don't have a plan and you're starting out in the financial world or you're living in the financial world, you're often just like a rudderless ship. What does that mean, Brian? What does it mean to be a rudderless ship?
If you're rudderless, it's hard to get to navigate because look, you have to be very deliberate with every dollar in your army of dollar bills. And if you don't have a plan, if you don't have the rudder to navigate, you don't end up in the final destination that you're seeking for. And that's why, look, we have created a system, and I think it's so important, because I just covered the big stuff. Like I talked about housing, I talked about cars. A lot of you, I had family in town for my daughter's graduation, and I had my own sister-in-law asking, hey, should I be considering doing Airbnbs when I know we're still working on maxing out retirement plans and things like that. So there's a lot of people who don't have the knowledge or can't figure out what to do with their next dollar. And that's why we've tried to create a system. Guys, please take advantage of. Go to moneyguy.com/resources. We have the financial order of operations. And then if you want a deep dive, if you need to accelerate your financial mutant status, you can also go to learn.moneyguy.com. And we have a great course to help you maximize as well as accelerate your wealth building process.
And this is for the do-it-yourselfers out there. If you want to know, hey, what should I be doing? How should I go? I'm not quite ready for taking the relationship to the next level, but I need something more. I've had a plan in place, and now I need to improve upon that plan or understand some of the whys behind the plan. That's what the course is for. But if you are someone who says, you know what, I've done the course and I've worked through that, but man, things have gotten complicated, or the numbers are so big that I'm uncomfortable, or I'm so busy, I need a co-pilot. A great way to get a plan in place is to think about hiring a relationship to help take your finances to the next level. That's what we get to do on our day job. So if you want to know more about that, you can go to aboundwealth.com, work with us. You can check out what it is that we do, how we do that. Because when you have a plan in place, one of the biggest things that will help you do is not skip steps.
Yep.
I get so frustrated, specifically with folks in my stage of life. And they're still, what I would say, in like the foundational building phase, and yet they go upgrade the house, or they go buy the luxury car, or they go start doing the rental property, like you said. And they don't realize that there's an order and a structure to doing this. Well, with a good plan, you can make sure that you're following the steps in the right way and not getting ahead of yourself, not getting out over your skis, not getting overextended where you're setting yourself up to potentially fail down the road.
Well, I think having a plan also keeps you from getting desperate, because I think, I think, like I said, the conversations I have where somebody tells me they want to get into doing Airbnbs or real estate, I'm like, wow, we skipped some steps in between there. But I think there's just this pressure that you feel like, hey, if I'm sitting on cash or I don't know what I'm doing with my next dollar, I need to be doing something, because this is what I'm seeing on social media is how everybody's making their money right now. You need to cut out all the noise, and that's why I love that we have created a step-by-step so that you can know, hey, cash reserves are important, because even though, yes, they don't pay a ton right now, it is going to be just like oxygen is so important to us and we take it for granted. Your cash reserves will get you through whatever may be coming our way. Risk and estate planning, like your insurance, your estate documents, your life insurance, all these things need to be taken into account. Where does that fall into this? You need to have a plan of action as well as the debt and retirement savings. Don't overlook these things. Have a plan so that you don't get yourself in a pickle where you're really making bad decisions because you just were floundering and rudderless and not knowing what to do.
So if one of the reasons that Americans are broke is because they don't have a plan, I think that it also compounds into this second reason why we think that Americans are broke, is it's the idea that they like to live beyond their means. They like to create a lifestyle that maybe is not as realistic of a reflection of where they should be. They start faking it and end up in a really negative position because of that.
And this year, in 2022 specifically, I mean, I feel like we have compounded the issues because we already have a discipline problem here in the United States. And now we're going to put all these macro things on there that are making the basics much harder.
Yep.
We've got to, guys, it gets hard and it puts more and more on your shoulders to make sure you're doing it right. We've made it through planning, but let's talk about faking it until you make it. In the past, that was just didn't hurt you as much as it does now. You really have to be careful now with the basics like credit card debt.
It's really, really interesting. If you look at right now, 47% of credit card users carry a balance from month to month. This is from this status from Clever and Value Penguin. It's really, really interesting. So we don't say that credit cards are bad and they're negative and you can't use them and you got to run away from them at all cost. But if you do fall into this 47% of folks that are carrying a balance over and over and over again, it should be no-go land for you, because the average American household right now has $6,300 in credit card debt. You've heard us talk about compounding interest is the eighth wonder of the world. It can be so amazing. It can be the wind in your sails when it comes to building your army of dollar bills. But if you let it start working against you, if you start running up debt on credit cards, you are turning something that can be so powerful, so awesome, so amazing into a huge headwind that is incredibly, incredibly, incredibly difficult to overcome.
Well, credit cards, lifestyle, those go hand in hand. I think also the car loans.
Yep.
You know, this is something this sad trend I've seen is everybody focuses now on their monthly payment versus the actual debt that they're carrying. And the proof of this is the average car loan is now 72 months.
I think it's so interesting. I have a lot of friends, Brent. Most of my peers don't even drive cars for 72 months.
Yeah.
Like they don't even keep their car for that many years, and now they're going to borrow money to pay it off. It doesn't make sense to me.
Well, we dug deep into this. We figured out, hey, the 72 months is not just how long they're financing the car, because it's how long people are carrying all that negative debt. Because 1 in 3 people who trade in a vehicle are actually underwater. So it ties into exactly what you're saying. People aren't even paying off the cars before they upgrade, and that's creating a lot of negative equity. It's creating a drawing out of debt just so you can fake it until you make it. And with all these macro things that are also going on with inflation, this is bad for people's long-term wealth creation.
So if this is the wrong way, Brian, if borrowing money over 72 months and rolling in negative equity is not the thing that you should do, what is the thing that you should do? How should you approach buying a car? Because right now, cars are kind of wild too, right? Like we didn't even talk about that a ton. New cars are selling for over MSRP. Used cars are actually appreciating in value. If you're someone, and I even saw this comment a second ago, but yeah, what happens if you have to buy a car right now? Like what if your car goes, if you have to do it, what are some things that you could say? What are some ways to like make sure we're doing what we ought to be doing when it comes to car purchases?
I know. Look, it's all about the discipline, and the 23.8 still holds up. Is that we're giving you permission to do financing on a basic car. You just have to make sure you do 20% down. Don't finance it for more than 3 years. And then the payments can't exceed 8% of your gross income. And if you look at always people need a little clarification on this. Take your car payments times 12 and then compare that to your annual income, and that will tell you if it's 8% of your gross income. And all this is to make sure that your eyes don't exceed your wallet or purse, is because a lot of people, because remember, they can finance your car out for 72 months. That's twice as long as what we're saying with 36. That could hide a lot of bad decision making, because they can get your payment down substantially by just drawing this out forever. The problem is you never own it. It depreciates, because I know right now we're all thinking, hey, we're in a new paradigm. Cars actually appreciate.
Go up in value.
No, because look, here's the canary in the coal mine. Pay attention to boats, RVs, then automobiles, and then real estate. If we are in a recession, which it sure feels like with all these exterior things like inflation, the housing prices, there's a lot of things that are showing the GDP going negative, a lot of negative stuff. Pay attention to the canaries in the coal mines. Boats, RVs, automobiles, they're going to go in that order. I think I mentioned in a previous show, driving to work, I have passed 2 RVs that have for sale by owners in the front. I haven't seen boats because there's not a lake around where I live right now, but there's definitely RVs that are for sale. It's going to pass that you're going to be able to get cars. Just don't lose your mind and lose your good core competency of making good decision making.
And in addition to 23.8, there's 2 other things. If it's a luxury car, you don't get to do 23.8. If it's a luxury car, you got to pay it off all inside of 1 year. And the second thing is you cannot let your monthly car payment be more than you're saving to your investment portfolio on a monthly basis. If that's the case, then you're out of whack. So, Brian, we're talking about living beyond your means, folks that are stretching it. So credit cards is pretty obvious. Car loans is pretty obvious. I want to talk about student loans for a moment. We've already talked about how, the way to pay it off is if you're above 6% in your 20s, you should prioritize, above 5% in your 30s, above 4% in your 40s, and then knock it out by your 50s. We had a brief conversation. I don't want to get off on a tangent here.
Yeah.
But we had a brief conversation in pre-show about what's going on with colleges, how they're attracting students, what they're doing. And I know from some folks that I'm kind of mentoring right now, the thought process, I ask somebody, hey, how are you doing this? How are you doing that? Like, oh, that's what my student loans cover. Yeah. I go to in-state, I got public, I've got tuition covered. My student loans are for fill in the blank.
Yeah.
Speak to that a little bit as it relates to lifestyle.
I had a unique conversation because I have my daughter graduated high school last week. I had my niece and nephew in town, they're college. And my niece specifically, we were talking about student loan debt, and I I'm so proud of her and the fact that she became a resident assistant, so she got her housing for free. She was doing all the right decisions because remember, the Money Guy guidance is don't come out of college with more student loan debt than you're going to make in your first year. And here's why this sounds like common sense, but it's so hard these days because, Bo, you and I were in Athens not too long ago. For the Bulldog 100.
Right.
And I was amazed. I mean, when I was in college, the dorm experience was cinder block walls, air conditioner through a portable unit that was strapped to the window.
How was the shower?
And you went to the shower and there was like a bunch of other people in the shower. I mean, it was a lot of people. You're sharing a lot of the same resources. It was anything but nice. And now I feel like college has become this all-inclusive resort where I don't know if you want to call it. Y'all thought this was my Hansel and Gretel analogy or Hotel California was way too dark, but it does feel like that they're encouraging everybody to come in to have the greatest 4 or 5 years of your life while you're in college. But then this albatross is going to hang around your neck for years. It didn't used to be like that. It used to be, hey, it's going to be a lot of great memories, but you're going to live like a Spartan, but you're young, you can enjoy and you can appreciate anything. So enjoy your cinder blocks, but make great memories with your friends, but go get an education, and you come out of school with a lot less debt. I do feel like don't fall prey, don't eat too much candy while you're in the Hansel and Gretel house with the student loan debt. No, this is serious because I want people to understand student loan debt is a trap. And I don't, until we start holding the institutions accountable for this, we have a problem. That's why a lot of this conversation about forgiving student loan debt, I think you can have that conversation if we also talk about what's the path forward
to fix
with the institutions on the rising cost of it, to making sure we're not entrapping the next generation and totally turning this thing that is a blessing, which is education, which is what powers this show, into a trap for the next generation. And I don't think that part of the conversation has actually been had.
No, I completely agree. So we've talked about living beyond your means, right? So that's running up debt, whether it be through credit cards or student loans or car loans. But maybe you're not someone who's faking it. Maybe you've actually, quote unquote, made it or arrived, but you're allowing your lifestyle to creep up. And what that's doing is it's causing you to focus more on present day consumption than future consumption. You haven't mastered this idea of discipline and deferred gratification. And here are just some interesting statistics to run through. Now, this data is from a few different sources. This is from the Bureau of Labor Statistics, MarketWatch, and the Consumer Electronics Association.
So this would probably have a little bit of a tail drag, meaning that it's a little headwind, because if the Bureau of Labor Statistics, so this is probably going to jump up in the coming year. Just watch it.
So if you look at the average American household right now, they spend about $288 eating out. They spend about $100, and by the way, this is per month. They spend about $100 per month on electronics. They spend about $156 a month on clothes or apparel. And they spend about $237 per month on subscriptions. Now, what I think is interesting is none of this stuff is like mind-blowing. You don't see one of these numbers like, oh my goodness, that's egregious, that's crazy. But if you add all of them up, they start adding up very quickly. And when you start looking at, okay, well, how much of my income, how much of my household intake am I spending in current consumption versus how much am I actually putting to work for my future self? I think a lot of folks find, man, I didn't realize, you said when you're in college, you could be a Spartan. When you come out of school, you can live off of $20 a week and it's amazing. And all of a sudden life starts happening and you start moving along and you kind of lose track of it. You lose track at how much life costs just because you let it happen over time.
Well, I think it just means you have to be much more deliberate.
Yep.
I mean, I think nothing can be taken for granted, especially when the big macro expenses, the shelter, your housing, your transportation, those things are running away from you. You are going to have to become much more deliberate with focusing on your consumption and your spending on where every dollar is super effective. So figure out, what's a want versus a need. And then once you kind of are so disciplined with getting it down, then make sure that the excess or the variable expenses that you have month to month is very deliberate in doing things that make you happy.
Yep.
I mean, so because I hate that we have to be this way. I like it when we live in abundance. And I'm not talking about just with money, but with memories, with experiences, with your family. And it does feel like now we are creating a point in time where you have to be that field general that's using all the tools. Don't forget tools like you need a budget.
Yep,
I mean, there are
tons of
apps and
things
there's
out
other
there.
things where you can actually start tracking this stuff, because if you're not budgeting, and you guys know that budgeting is not what I consider sexy, it's not fun, but it is so necessary when every dollar has to have a purpose while we're in these unique times.
You said it so well, Brian. I'm going to repeat it because I think it's so good. Figure out what it is that you value and spend your money on those things. Well, if you're doing that, the natural counter to that is recognize the things that you don't value and stop wasting your money on that stuff. If you have, I'm going to use a really silly example, but if you have a subscription service that you don't use, you just got it because you cut the cord and you found that you're too busy to watch whatever, think about cutting that out. If you don't really care about the types of clothing, or I'm going to use an example right here. I don't like spending money on clothes. It's just not something that gets me super exciting, except for athleisure. It's been my new thing.
Goodness gracious.
And so I won't go spend a lot of money on like a nice dress shirt because I don't wear nice dress shirts a ton. But like something for athleisure that I'm going to wear often and use it, and that's kind of my normal wardrobe, I'll spend money on those sorts of things. You have to figure out what is it that actually you enjoy, you actually value, spend money on those things, and learn how to cut out those things that you don't value, that should not be taking up space inside of your army of dollar bills.
So far, everything we've covered has been kind of economic stuff that's changed, consumption that's changed. Those were the first two steps. But the third one, and look, this is where I do feel like I'm kind of like the parent or the Debbie Downer in the room, and the fact, because I'm going to tell you a skill set that's actually going to be part of your wealth building journey, which is deferred gratification. When I go and somebody said, what's the one thing you go tell and teach in every high school? It's the value of deferred gratification. And I do feel like a lot of Americans, and it feels really sad to say this when there's all these other things in the macro sense that are squeezing people, but the paying yourself first still needs to be a priority. And that seems so tone deaf in light of all the other squeezes that are going on. But I'm telling you, you have to figure out, and that's why I love that we talked about budgeting. You have to figure out, even in these lean times, how you can get your money working for you. Because yes, the stock market is volatile right now. Yes, prices are going up. But I'm telling you, this is probably creating some of the best investment opportunities in the long term. So I have to be that responsible coach, that responsible guide that tells you, you too can make it. Don't let YOLO be the thing, because that's where there's so many people right now saying, hey, it feels like
today.
The world's coming to an end, so you only enjoy today. Don't worry about tomorrow because nothing is promised to you. I'm telling you, you will live to a ripe old age, and we will make it through this. But you just have to plan accordingly.
I think it's so interesting, Brian. You said the one thing that you teach classes, and I do the same thing, is deferred gratification. It may be the most important thing in the financial world. I'm going to be confessional for a second, right? I'm going to kind of like, we're going to pause. I'm going to talk to you guys about something because I'm worried about this, right? I think for some folks, deferred gratification comes easy. We just naturally get it. I think I was one of those folks. I was raised in an environment of scarcity. So it was really easy for me to think about doing away with a little bit today so that I can possibly have some more tomorrow. I got 2 little girls, Brian.
Yeah.
And I've done this marshmallow test, right? I've done it with my girls. I have one little girl and she gets it, right? She's a daddy's girl. She's just born that way. Like if I get her a chocolate milk we go out to brunch and I get her a chocolate milk, she's going to savor it. She's going to drink a little bit of it. And she's going to have some left over at the end that she can finish. And it's going to be great, right? I have this other little girl, man.
I know your children, so I know which one is.
As soon as that chocolate
she got
milk,
a funnel out over there.
It does, man. As soon as it hits the table, she just starts slurping. And,
she's so cute, though.
Oh, man. And we did the marshmallow test. She ate it before I could tell her what would happen if she didn't eat it, right? I recognize as a parent, right, if I don't start teaching her about deferred gratification, she's going to have a hard path.
Yeah.
She's going to have a hard time when she gets out there on her own. I'm a firm believer that deferred gratification, even if it's not something that comes natural, even if it's not something you've always been at, it's like any other muscle. It is something that you can work and you can stretch and you can practice and you can get better and better and better at it. But what happens is if you don't use it and you don't practice and you don't stretch it, it's never going to get better, and you're not going to have a different outcome if you don't start changing the things you're doing right now. When I hear deferred gratification, that's the thing that immediately comes to my mind. So if, maybe you're not trying to figure out how to not let your kids do this, but maybe you're thinking, oh man, I'm 20 years old, I'm 30 years old, maybe I'm 40 years old and I haven't gotten started on this yet. That's okay. Figure out how to start doing it now, and you will be amazed at how powerful it can be over the long term.
Well, I always think, let's give people motivation. I like to be a motivator because I want this educational journey we're on to be one of those things where you say, yes, times are tough, but a little can go a sure long way towards my financial success. And we have a great illustration, because this is, once again, like if I was talking to a high school group, one of the first things I'd focus on is deferred gratification, and then I'd focus on the components of wealth creation. Time can be your biggest benefit, because compounding growth, I think people are shocked because when you say start young, I'm talking about anybody under 40 years of age. What people don't realize is that when you're talking about getting that first $1 million, as long as you started before you were 40 years of age of saving something, 77 to 95% of your account value at retirement is actually going to come from the growth, not your actual contributions. But that never happens if you don't put those initial contributions in. So, Bo, we actually created a case study of 3 different people, and Daniel got kind of creative with how he wanted to name these, but we wanted to model the behavior so you can see the benefit here of somebody who said, okay, I'll stick my big toe in and I'll try this for a few years and pull out. And then somebody else who started very disciplined, walk them through this case study.
Yeah, so we know how much we love Roth IRAs, right? We talk about it all the time on the show. So we said, let's just look at 3 savers who get this idea they're going to max out their Roth. And right now, you can put $6,000 into a Roth IRA if you're under 50. And let's just say that they can earn 8% annually, right? So we'd say same savings, same type of investment opportunity. Well, our first investor, this is Brogan. Brogan decides, I'm going to save from 20 to 29 and then I stop. Right? I'm not going to say, I don't want to save for my whole career. I'm just going to save for the early parts. I just got out of college. I can live off of a little bit. I'm going to say, but when I get to 30, buddy, then I'm living. Then I'm going to do it my way. That's what a Brogan would do. Hogan says, man, I work so hard. I gotta reward myself. In my 20s, I'm not saving a dime. I'm going to live large. I'm going to do it up big. But you know what? When I get to 30, I am going to start saving. I'm going to get serious about it. I'm going to save. And by the way, I'm going to do better than my buddy Brogan, who only did it for 9 years. I'm going to save from 30 all the way until I retire at 64. So we got Brogan, we got Hogan. Well, then we got Logan. This is the third guy, and he's sort of a brainiac. He says, you know what, guys? I'm not going to do either one of those. I'm going to start saving at 20, and I'm just not going to stop. I'm going to start saving from the time I'm 20 all the way until I get to 64.
So
I'm going to kind of combine.
Logan's the financial mutant
Logan,
of the group.
He's the one with a tie on, right? So you got to figure he's the one who's putting things together. So when you look at it, Brogan, over his saving career, has saved about $60,000. Hogan, over his savings career, has saved about $210,000. And then when you look at Logan, his total savings is about $270,000. So Brogan didn't save a whole lot. Hogan saved pretty good, and Logan saved just a little bit more than Hogan, right? We all tracking here? All right, so let's look at our results. When they get to 65, when they get to retirement, Brogan has about $1.3 million.
Whoa.
That's fantastic. Hogan has still done fine, but he only has over $1 million.
Bo, you have to pause there. Hang on, because I don't want us to get to the final result. We know that the financial mutant who saves from 20 to 64 is obviously going to do great because you're consistent, paying yourself first, deferred gratification, just encapsulated completely. But we need to focus on, because I think this is a perfect illustration to show the power of starting early, and a little can go a long way, because Brogan only saved for 9 years, only had $60,000 invested, but yet his account was worth almost $1.3 million That means a little did a lot of heavy lifting. Hogan saved, I mean, look at this. This is like 3.5 times as much invested as Brogan, 60,000 versus 210,000. Yet the Roth balance is actually worth like $250,000 less at $1,033,000 versus the 1.3 that Brogan has. Guys, get to work on saving. And a lot of you, maybe you're watching this and you're not in your 20s. Maybe you're in your 30s or even 40s. It's not like your money stops working at 65.
That's right.
You're going to
That's a great
stay
point.
invested, and your life expectancy is going to be close to 80 years of age. So more than likely, as long as you're under 50 years of age, you have dollars that can get that 88 times growth in the long term. So don't, if you didn't start investing 10 years ago, if you didn't start investing 5 years ago, there's no better time to start investing than right here, right now, today.
So now let's look at Logan. You've already alluded, this guy probably did best, and you're right, he did. He saved just a little bit more than Hogan, right? And really just a little bit longer of a time period, but just stay consistent. He saved $270,000 over his working career, and his ending portfolio value is $2.3 million, all because he started early and he stayed consistent. The sooner that you figure this out, the sooner you recognize, man, if I can just sacrifice a little bit of today for some consumption in the future tomorrow, you are going to set yourself up to be in an amazing, amazing, amazing place financially. But you got to figure it out as soon as possible.
Yeah, as we kind of close out today's show, you know, there's so many things going on right now, and I love you guys have this open communication with us, whether you're writing us at moneyguy.com or whether we see it on the social media channels. But without a doubt, I want you to stay focused because you never know what you share with somebody that actually connects with them, and that's why I don't want us to seem tone deaf with all the rising costs, all the bad stuff going on. A lot of you are really feeling like the system's working against you, but this is where maximum financial opportunity can actually be in the background working for you. I have no doubt. I feel like we are, because it's backwards looking. We're likely in a recession right now. They won't know until the second quarter's GDP numbers come out, but it sure does feel like a recession right now. And a lot of you, because if you watch the financial media, they're going to tell you why you should be scared, why you should not be optimistic. But here's what I know. On Twitter over the weekend, somebody posted, "Always be buying." And somebody said, "I love that saying. Where'd you get it from?" He goes, "I heard it from the Money Guy show, and it just always stuck with me." And I want you guys to know that is exactly where we have the darkest moments are actually the bright spots in your long-term investment plan. So I want you to drive through it. I want you to always be buying in these times that seems very counter to what you emotionally feel. But this is why we haven't reached the full 20% downturn to be classified as a bear market, but it does feel like we might be getting close. Sure. And I just want anybody and everybody who's watching this, bottle up the emotional feelings, but I want you to make sure you don't let the emotions impact your actual financial behaviors. And that's a skill set that goes counter to your instincts because your fight or flight is real and you're trying to figure out, how do I make myself emotionally feel better? Fight that. Bottle it up. Take the steps that today will feel hard, because the buy low, sell high, that nobody ever describes the fact that buying low actually feels horrible at the time you're buying low. It's very scary. Everybody else is leaving. Always be buying will protect you from even that emotional stuff. Stay focused. Use the resources. You know, we talked about budgeting apps that are out there. Know what your cash flow is. Know what your goals are. Know what your why is. And then if you need purpose, if you need direction, use the tools that we're giving away. The Financial Order of Operations, we have been working on designing, perfecting this for years now. You can be the beneficiary of it, so don't pass that up.
If you've not checked out the website, you can go check out moneyguy.com. In addition to Financial Order of Operations, we have tons of resources out there available. If you want to know more about what it is we do in our day job, you can go check out aboundwealth.com. You keep letting us know what you want to hear. We will keep delivering content to hopefully help you take your finances to the next level.
Guys, I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team, out.